Do you want to invest your money, but feel overwhelmed by the sheer number of options out there? Are you constantly hearing about Wealthsimple, but also intrigued by the idea of managing your own investments? You're not alone. This is a question many aspiring investors grapple with: Wealthsimple versus DIY investing. Which one truly comes out on top for your financial future? Today, we're diving deep into this exact dilemma. We're going to break down both Wealthsimple, a popular robo-advisor, and the world of do-it-yourself investing, exploring their pros, cons, costs, and ultimately, help you decide which path is best suited for your individual financial goals and comfort level. Let's start by setting the stage. Investing can feel like a complex beast, filled with jargon and endless choices. For years, if you wanted to invest, you either went to a traditional financial advisor who often charged hefty fees, or you had to learn the ropes of stock picking and market analysis yourself, which is a significant time commitment. But then came robo-advisors, like Wealthsimple, promising a simpler, more accessible way to grow your wealth. So, what exactly is Wealthsimple? At its core, Wealthsimple is a robo-advisor. Think of it as an automated investment manager. You answer a few questions about your financial goals, risk tolerance, and time horizon, and their algorithms construct and manage a diversified portfolio for you. This typically involves investing in a mix of exchange-traded funds, or ETFs, which are essentially baskets of various stocks, bonds, or other assets. It's a set-it-and-forget-it approach, designed to take the emotion and much of the heavy lifting out of investing. On the other hand, DIY investing means you are the captain of your own financial ship. You choose the brokerage platform, you research the investments, you decide what to buy and sell, and you manage your portfolio's rebalancing. This could involve buying individual stocks, bonds, ETFs, mutual funds, or even venturing into more complex instruments like options or cryptocurrencies, depending on the platform you choose and your level of expertise. Now that we have a basic understanding, let's compare them across several key areas, starting with the most tangible: cost and fees. When it comes to Wealthsimple, their fee structure is relatively straightforward. For their managed investing accounts, they charge a management fee based on the total value of your assets. For accounts under $100,000, it's typically 0.5% per year. If you have over $100,000, that fee drops to 0.4%, and for very large portfolios over $500,000, it can go even lower, down to 0.2%. Keep in mind that these fees are on top of the very small underlying expense ratios of the ETFs themselves, which are usually around 0.1% to 0.2%. So, for a typical account under $100,000, you're looking at a total cost of roughly 0.6% to 0.7% annually. This fee covers portfolio management, automatic rebalancing, dividend reinvestment, and access to their financial tools and human advisors for premium and generation clients. They also offer commission-free trading for stocks and ETFs on their self-directed platform, Wealthsimple Trade. But they do charge a 1.5% currency conversion fee if you're buying US-listed securities in a CAD account, which can add up. With DIY investing, the fee landscape is a bit more varied because it depends entirely on the brokerage platform you choose. Many modern DIY platforms, often called discount brokerages, offer commission-free trading for Canadian and US stocks and ETFs. This is a massive shift from even a few years ago, where each trade would cost you anywhere from $5 to $10. However, like Wealthsimple, some DIY platforms will charge a currency conversion fee for US dollar trades if you don't hold a USD account. Some platforms might also have inactivity fees, account maintenance fees, or fees for certain types of investments like mutual funds or options contracts. The biggest cost factor in DIY investing isn't always the direct trading fees, but rather the potential for opportunity cost if you make poor investment decisions or fail to rebalance your portfolio effectively. So, on paper, DIY investing can be cheaper if you pick a commission-free platform and manage your own currency exchange, but the savings might not be as significant as you think once you factor in other potential costs and the value of your own time. Next up, ease of use and accessibility. This is where Wealthsimple truly shines. It's designed for simplicity. The onboarding process is quick and intuitive. You answer a few questions, they recommend a portfolio, you deposit your money, and they handle the rest. It's perfect for beginners or those who simply don't have the time or interest to dive deep into investment research. Their platform is user-friendly, with a clean interface and a mobile app that makes it easy to check your balance and see your progress. They automate processes like dollar cost averaging and dividend reinvestment, which are crucial for long-term growth but can be tedious to do manually. DIY investing, on the other hand, requires a higher degree of self-sufficiency. You need to open a brokerage account, which can be more involved. Then, you need to research different investment options, understand market trends, and make informed decisions about what to buy and when. You're responsible for diversification, rebalancing your portfolio periodically to maintain your desired asset allocation, and understanding the tax implications of your trades. While many DIY platforms have improved their user interfaces and offer educational resources, it still demands a significant time commitment and a willingness to learn. For someone completely new to investing, the sheer volume of information and choices can be overwhelming, leading to analysis paralysis or, worse, bad decisions driven by emotion. Now, let's talk about diversification and portfolio management. Wealthsimple's core offering is professionally managed, diversified portfolios. They typically use a globally diversified mix of low-cost ETFs covering various asset classes like Canadian equities, U.S. equities, international equities, emerging markets, and different types of bonds. Their algorithms automatically rebalance your portfolio to maintain your target asset allocation as market values fluctuate. This passive, diversified approach is widely recommended by financial experts for long-term wealth building, as it minimizes risk and typically outperforms active stock picking over time. They also offer features like tax loss harvesting in non-registered accounts, which can help reduce your tax bill, something that's difficult to do manually. With that said, thanks for watching and until next time.